Hello, everyone, and welcome to the fourth quarter 2020 investment market review. My name is Bob Dunn, president of Novi Wealth Partners. Today, I will be joined by Mario Nardone, our chief investment consultant. Each quarter, we create content that is relevant to all investors and based on science, not speculation. We intend to provide knowledge and guidance, not sensationalized forecasts on future investment outcomes. As fiduciary advisors, our primary goal is to do what is in your best interest. You will not find us chasing the hot stocks or pretending that we know the future. In place of the traditional investment entertainment, we intend to make sense of what is going on today in the investment world and what that means for you. Today, Mario will look at what has happened in the investment world during this past quarter, as well as provide some education and context to what is consuming most of the investment headlines today. I look forward to what you have to say for us, Mario. So let's hear it.
All right. Thanks, Bob. And wish you and your community Happy New Year, happy and healthy New Year, I should say, and well beyond that.
Thank you, Mario, and I'm right there with you.
So COVID-19 obviously dominated the news throughout the year. We could certainly say we're not out of the woods yet. But we could also probably say it's better to be looking forward from now versus where we were a year ago. Wouldn't you agree?
Yeah, I'm grateful for the vaccine. I'm glad to see it's rolling out, and we're seeing more and more people getting it and accepting it. So let's hope and getting a little ahead of ourselves. I think the markets are starting to see some reaction to that as well.
Absolutely. So speaking of the vaccine, as you know, we like to start the presentation by looking at some of the reasons for optimism on the left and reasons that maybe there's some concern or even just uncertainty on the right side of the page. So starting on the left, first and foremost, you hit the nail on the head. Clearly, the vaccine is good news. Also, we know that there are better treatments now than in the past, and especially a year ago. And we just generally understand the disease a lot better. We continue to see that the Federal Reserve and the government have shown a willingness to step in as a backstop for the economy. In December, there was another $900 billion aid package approved. And then the last bullet point, we did see finally, 4 years after the referendum, that the EU and UK did reach a Brexit agreement. Now, while this is a positive development, the details will certainly take a while to sort out. This is probably one of the biggest bureaucratic nightmares that hopefully any of us will ever live through in our lives, and it'll be interesting to me to see how long it takes before they work it out.
Yeah, it took them a long time to come to agreement to come together to create the euro, and it obviously took some time to unwind it.
Yeah, and it certainly has some economic consequences that we'll be watching very closely.
Yeah.
So that sort of segues over that, kind of blurs the line between positive and negative. But, some other things that are more on the pessimistic side is that, we can't dismiss the fact that the virus is still here.
Yeah.
Yes, we have vaccines, but, what is it? 2 or 3% of the population have gotten them so far. Also, economic activity still is below pre-COVID levels. And as that last bullet point states, it's well below pre-COVID levels for certain people. The K-shaped recovery, meaning that not everyone's recovery is or will be the same in speed or magnitude.
Yeah.
So this graph here shows you the roller coaster ride of 2020 in the U.S. stock market, and in particular, the S&P 500. And usually roller coasters build the tension with a slow climb away from the ground, and then you get the dramatic plunge. This one was a little bit different. You can say we got the free fall early, then the gradual climb with some twists and turns along the way. For me, if you look at the top left, and though we don't expect you to be able to read every single one of these headlines, but the top left is a reminder, a surprising one at that the biggest news story to start 2020 was escalated tensions with Iran. And, quite honestly, only until maybe last week, I hadn't even thought about Iran-US relations. COVID, as I mentioned, dominated the headlines ever since, but the real turning point was in March. And you see how the S&P 500 bottomed out, towards the left side of the graph here. And that is when the Fed and the Senate both offered relief to COVID's economic impact. And we've seen the market climb fairly steadily with a few bumps along the way through the end of the year at the far right of the page.
Yeah.
Yes, were you going to say something?
Yeah, I'm just going to say that I'll let you finish, but I was going to say that these slides, this slide in particular, I love it. This is the sound bites that the financial entertainment makes money on by putting these headlines out there. This is fear and excitement at its best. These little tidbits of news will be sensationalized and blown up and give direction to say, buy, sell, scare, be fearful, be elated, whatever. It's playing with everyone's emotions. And the fact that, the way you're going to frame it and you're framing it and looking at it is from a factual standpoint. And basically it's behind us. We made it through it and we didn't react. If anything, we did positive things during this, which improved client returns. So sorry to interrupt.
Absolutely. No, absolutely. And we've enjoyed the relationship throughout it and having conversations. What should we do? What shouldn't we do? And, you and your clients weathered the storm quite well. And I think as long as cool heads prevail, we'll continue to weather whatever future storms come our way.
Just one more thing I'll make on this to interrupt. Sorry, continually interrupting you here, Mario. I just want to say some of the activity that we were performing during this time is we're looking at the accounts, and during the decline, that was about a 23% decline in the beginning of the year through March, or 33%. What was the figure?
Yeah, something like that.
Yeah, it was massive. We were rebalancing portfolios and buying stock, not because we knew it was going to turn around, because we have triggers internally that we set to say, okay, when it hits a separation or point, we're buyers of positions that are out of balance or out of our tolerance or ranges that we set up. So again, it's not we're timing the market. We set parameters beforehand through investment policy and then follow the policy to take the emotion out of it.
Absolutely. That's the key. So I mentioned in the beginning this reference to a K-shaped recovery, and you're looking at what that means on your screen now. Broadly speaking, we can say that the vaccine is positive in a collective sense, but what the K-shape represents is that we all suffered the shutdown, which is the red arrow pointing down at the left side of the screen. We all benefited in one way or another from the reopening or stop and start reopening of the economy. But as we really dive in and look at where we have gone and where we're going from here, you can see that not everybody is benefiting or will benefit the same in terms of speed or magnitude. And this graph shows that. So if you look at the very top of this page, you see one clear example, and that is the sellers of gym equipment, meaning home gym equipment, have done well from this working from home and staying home environment. But the mirror image on the bottom of the page, gym memberships have suffered. So, clearly there are winners and losers. On the right side of the page, another one in the real estate market. Residential real estate activity has been super hot, but commercial real estate, especially retail and office space, really have suffered through this environment. And again, we know different parts of the country also have had, different levels and speeds of their recovery. So there's all kinds of examples that we could think of, but the main takeaway is that we're a long way from returning to our pre-COVID economy.
Yeah, and one of the things I'll just say upon that slide is diversification. We couldn't have predicted what the outcome was. There's gut, there's feelings, there's ideas, but participating in the broad market is always most advantageous.
Absolutely. So, well, we could talk about the market. Sorry, got off train of thought there. So we can look at fixed income returns, which fixed income is another fancy name for bonds. And we can see that bonds were mixed in the fourth quarter, and that's highlighted by the group of bars on the left side of your page, showing the fourth quarter of 2020. Bond returns were mixed during the quarter, and that's generally due to the return of investors' risk appetite. As you'll see when we talk about stocks, riskier segments of the bond market, like corporate bonds, which are represented by the orange and light blue lines, were positive during the quarter, while safe haven Treasury bonds sold off a little bit. And those are represented by the purple bar pointing down, showing a negative 0.8% return. For the year, which is represented by the other batches of bars, which in this case represent the same period, the year to date and the last 12 months, bonds did quite well, with intermediate term bonds in the 9 to 10% range. Unfortunately, we have to remember that when bond prices go up, their forward-looking yields go down. And that's reflected on the slide you're looking at now. What this represents is the Treasury yield curve, meaning what are Treasury bonds of various maturities yielding at a particular point in time. And if you look at the solid line representing December 31st, you see that yields are at incredibly low levels. And that represents our forward-looking return from holding these types of securities. And if we think back to a year ago, the 10-year Treasury had a yield of about 1.9%. But as we discussed on the previous slide, that same intermediate term Treasury bond had a 9% return. So we can't expect the return going forward to be as high as it was a year ago. And as this graph shows, the 10-year Treasury is currently yielding about 0.9%, which, by the way, is the lowest end of year yield ever for 10-year Treasuries.
Wow.
Now, what's really important is when people ask, well, why would we hold these kinds of securities at such low expected returns? And the reason is because Treasuries are one of, if not the best diversifier of our equity risk or our stock market risk in our portfolio. Furthermore, we get the question often about what can we do about cash? What should we do with our cash? And if you look at short-term yields, which are those on the left side of the page, near 0.1 or 0.2%, it's enticing to consider taking more risk to try to get a better return out of cash. But we think that that's definitely worthy of additional consideration. And in fact, we think that low yields are just, in fact, the cost that we're paying right now for the liquidity and safety of those cash holdings.
Without a doubt. I mean, all the investment policy is based on a personal circumstance. When do you need the money? What age are you? What are the purposes of it? And so that's going to determine, where on this line you're going to place yourself. And so if you need, protection of your capital because you have an expense that's coming up, you may have to have a decent amount of this or be on the shorter side to ensure that the money is there when you need it. But if you have a longer time horizon or the need for resources is not dependent upon the cash or the investments that you have in your portfolio, maybe you can go out a little further, but you don't necessarily want to take on too much risk because you're not receiving any additional reward by going further out.
Exactly. And that you bring up a good point that we need to remind our investors that we don't just hold treasuries. We spend a lot of time thinking about how to allocate our bond portfolios. We do have non-US holdings. We have corporate bonds in there as well, where we think we can get a little bit better return without giving up the protective power of treasury securities.
Exactly.
Now, to make to extend that cash conversation and to make the low yield conversation even more complicated, we're starting to hear a lot more conversation about inflation. Unfortunately, it's not really a clear-cut situation, as this graph shows. The solid black line shows you the inflation rate going back to 2018. So you could see it's fluctuated between maybe it started at 1.7, went up to about 2.1, got down to under 1% in the height of the economic shutdown, and now we're back at about a 1.5% rate. Now, from here going forward, the feelings are mixed, and that's represented by the two dotted lines here, representing two big financial institutions, Morgan Stanley and Goldman Sachs, and their respective inflation forecasts. Now, just to get into the weeds a little bit, some of the rationale for expecting inflation are all the government stimulus that we already talked about, and a possible spike in economic activity, basically because people haven't been able to travel and spend money on things that they would otherwise be doing. So there might be a pent-up demand that would spring free if and when the vaccine and immunity takes hold. Arguments against it include the continued high unemployment rate and just general slack in the system due to the pandemic. Now, Bob, I think you can agree, we're not economists. We don't study inflation. We don't make predictions, but we do think about how portfolios are positioned for certain environments. Investors, as we talk to our clients and think about our model portfolios, we'll think about it in a way that, make sure we're thinking about investors who are more concerned about inflation. They might consider adding a hedge to the portfolios, in which case we'll look at securities like inflation protected bonds. Others who maybe have a longer time horizon or a different view of inflation could take the position that the higher returns from our stock portfolio will more than compensate investors over and above any inflation that might persist. So, and I know that we're having these conversations behind the scenes, and definitely more to come on that topic.
Yeah, I mean, the one thing that comes to my mind, there's a bunch of thoughts, but one thing that stands in the forefront is that we have a large group of clients that are fairly conservative. And so what that would mean is you're going to take a lot less equity risk. And so if you're not getting the return, like you were saying, on the equity side of the portfolio, and you're worried about your purchasing power and how you're going to be able to pay for goods that are rising in price or maintain and stay with the dollar, well, we may want to add some assets that are going to be able to protect for that, for the client that may have, or the person that may have more in fixed income investments. So diversify a little more towards the inflation protected bonds.
Exactly. So one area of the bond market we don't often discuss too much on these calls is municipal bonds. And mainly we don't discuss them because they're traditionally pretty safe and most people think they're pretty boring. But that being said, there had been some fear, and there's still continued conversation that COVID would put a lot of pressure on muni issuers' revenue, especially those that are derived from taxes on economic activity. And this graph shows that while default rates, meaning the issuer either missed a payment or didn't pay back its principal, default rates have picked up a little bit in 2020 on the right side of your screen. It was still not as bad as any of the great financial crisis years on the left side of your screen. And when you consider the absolute level that this chart is showing you, even this elevated level of defaults, it's still only 70 municipal bond defaults. And when you consider the thousands and thousands and thousands of issuers, not just issues out there, that's a pretty small portion. And we are getting more information every day. Bob, you and I talked about it earlier today, that the hits to the revenue really haven't even been as bad as expected. In some cases, tax revenue is higher because of property values. And also we're hearing that issuers were more financially sound and prepared going into this crisis than they were 10 years ago. And compound that with the fact that where we do use municipal bonds, we pay a high degree of attention to credit quality and make sure that we're invested in higher rated bonds, which limits that downside exposure.
Yeah. I mean, what you just mentioned there, when we implement, for the most part, we're using mutual funds for the greater good. And like you said, those mutual funds are based on higher quality fixed income instruments. And there could be hundreds, if not thousands, of bonds in there. And so what we're doing is avoiding any non-systemic risk, basically saying if one bond were to default or miss a payment, that's not going to impact the overall value of the portfolio. It's not going to be an issue. But if you go out and you're buying your own municipal bonds, or you have a concentrated portfolio of 10 or 15, and they're not well spread out into different areas, well, that one bond that defaults or misses payments could either see a major price decline or go away altogether, and that's going to impact your overall portfolio. So yes, the implementation, there's a lot of thought that goes into how we can avoid issues or minimize the potential impact of any particular investment for a client.
Yep. So turning our attention to what everybody tends to prefer to talk about besides bonds, we're looking at the returns of the stock market. And again, the left side of the graph shows you the returns for the fourth quarter. And you'll see that the ride was even wilder. This roller coaster ride we talked about early on when you actually look under the hood at other market segments. In particular, during the fourth quarter, those three tall bars in the 30 to 33% range represent small company stocks, which turned in some of the biggest quarterly gains since Russell started tracking them in 1978. So this is a big year for small companies. Part of that logic, or I should say big quarter, part of the logic behind this rebound is that smaller companies were hit harder by the shutdown and might stand to gain more from the vaccine and subsequent rebound. Now, all that being said, we still suggest refraining from investing based on some kind of a prediction or even that expected outlook, especially since we are, still a long way from widespread immunity, and it's just not a style of investing that we espouse. Rather, we do espouse that we own small companies. We espouse that we own large companies. And that, to your point earlier on the bond conversation, that diversification goes a long way in protecting our downside.
Yeah. Another element I take away from that, Mario, is do you think we'd be having this conversation in March or February that we'd be looking at returns for the year, looking at the middle columns of potentially 38, 20, 20% returns? We could predict that, yes, the markets will be up by the end of the year. But this is a stark contrast as what people may have been feeling during February and March.
For sure. Definitely. And I wouldn't have been the one trying to make a prediction one way or another, but
Nope.
as we talked about, just sticking to our plan, understanding that we have a long-term approach and not trying to get caught up in those prognostications.
Most definitely.
So another way to look at the market, or the bifurcation of the market between large and small stocks, and actually in a reversal of previous quarters reporting, this page shows on the top that through October, a handful of stocks known as the Fang Stocks, and that's Facebook, Apple, Amazon, Netflix, and Google, all outperformed the S&P 500, which in this case is represented by the yellow line. So again, January through October, the Fang stocks all outperformed the S&P 500. And by extension, that means the other 495 stocks collectively underperformed the market as a whole. But in November and December, as the bottom graph shows, out of the Fang stocks, only Apple outperformed the S&P 500, meaning exactly the inverse. And to your point, Bob, we would never concentrate in just a handful of securities. Yes, we recognize that, the Fang stocks were the drivers of performance. There was a tendency for people to say, why shouldn't I just plow all my investments in these stocks? Well, this reversal is the reason why. And certainly we don't know where we go from here, but logic tells us that the same 5 stocks can't continue to outperform forever.
Correct. Yeah.
So in terms of volatility, or the actual, movements up and down in the stock market, to your point on the graph that showed all the headlines, day to day headlines do move the markets, but they don't necessarily mean a whole lot in our long-term investments. But 2020, in terms of volatility, had more days of 2% swings or more than any other year since the financial crisis, and only slightly fewer than 2002, when the dot-com era was still eroding or imploding, and 9/11 was still fresh in our minds. So in other words, it really has been quite a ride in 2020.
Without a doubt.
So outside the US, the fourth quarter was strong as well, lifting what had been pretty lackluster results up until then. As the green bar shows, emerging markets outperformed, largely driven by China, which is its largest constituent, which had gotten coronavirus a bit more controlled sooner than other nations. So that's why you saw that emerging market spike in the fourth quarter. And again, if you think about what those year-to-date returns would have looked like without the fourth quarter, they're pretty dismal. So definitely glad to see a little bit of a rebound internationally as well, since we do have a portion of our portfolio invested outside the US. And no conversation about international stocks would be complete without a conversation about the dollar. Specifically, that a weakening dollar is beneficial for our investments abroad, even as the headline says, even if it's not beneficial for us as consumers of products made elsewhere. But as the bottom graph shows you, the dollar fell against a reference basket of foreign currencies, which contributed to the positive returns from international stocks that we just discussed. As we approach the end of our presentation, we usually like to include something a little bit more lighthearted, but also something that is very telling about what our economy looked like last year. So I would just point out that in a headline that's pretty suitable for playoff football season, you do see that things like microwave popcorn, which goes hand in hand with Netflix watching and more entertainment happening at home rather than out at bars and bowling alleys and everywhere else that people go to get their entertainment. And so anyway, I should describe that what you're seeing here is the year-over-year increase in sales of each of these products. So you see about a 30% increase in microwave popcorn in 2020 over 2019. Paper towels and bathroom tissue, we all know about the hoarding that was going on early in the pandemic and probably continued throughout the year. What'd you say?
I'm never going to forget that.
Yeah, never ever, right? And then other things like mac and cheese and frozen foods and packaged coffees. We can be pretty sure that a lot of those sales are a result or came at the expense of restaurant dining and fewer workers stopping into Starbucks on their way into work. So certainly, there have been some beneficiaries of this environment, but I think we can also agree that that's not to say we'd want to see it continue for much time.
Yeah.
So as we round out our conversation, we have a list of things that we always like to focus on or remind people of that, really guides our thinking in terms of investments and financial planning. The one that's bolded there is always true. But as we talked about throughout this, conversation, we think that we prepare our clients for withstanding the risks of stock markets by appropriately assessing their risk tolerance, appropriately allocating their portfolios in a manner that helps them meet their needs, but also in one that can keep them in their seats and sleep at night when there is volatility in our markets. So with that, I'll just thank you all for your time. Thank you, Bob, for inviting another conversation, and look forward to working with all of you and speaking with you again next quarter.
Thank you, Mario. I appreciate all your well thought out insight here and taking the time to pull this together. And want to thank everyone that spent the time viewing this. If you have any questions or some feedback about what was presented here, please feel free to reach out to us. We'd be happy to expand or share any additional insights that you may be hoping to hear. So thank you very much.